If you've been on social media the last few days, you've probably seen a lot of people go, "Buy the dip, bro," or "dollar cost average." But what does it all actually mean, and how can it end up making you money over time? First, let's talk about buying the dip. So you've got a few options. You've got garlic and herb, barbecue, Frank's Red Hot. Oh, wait a minute. I'm talking about a different dip. Okay, that was my pathetic attempt at trying to be funny. But anyway, let's talk about buying the dip. So essentially what we mean when we're buying the dip is we're talking about buying a stock at a discounted price. Now, the reason for the price being discounted is what's important. Now let's take a company like Apple. The fundamentals of Apple's business haven't changed in the last month or so, but their stock price has gone down very significantly. This is just due to overall market conditions, as all tech stocks were down in the last month or so. So that poses an incredible buying opportunity for people to pick up Apple at a discounted rate. So there's been several stocks over the last few days and weeks that have been down significantly, not through any changes in the business fundamentally, but just due to overall market conditions and the way the market's been going recently. So this poses great buying opportunities for investors. But the issue is, when is the dip? When is the lowest of the low? And the truth is that even professional analysts won't be able to tell on a given day when the stock price is at its lowest. So is there actually a strategy we can use to mitigate against this and take advantage of the dips? Well, yes, there is, and it's called dollar or euro cost averaging. So dollar cost averaging can be simply defined as investing a set amount at regular intervals into the same stock or mutual fund over an extended period of time. So as we discussed earlier, even the most experienced analysts can't pinpoint exactly when the cheapest price in the market arises. So the age-old cliche of time in the market beats time in the market always rings true. So let's just look at the S&P 500 over the last 5 years to kind of give an idea of dollar cost averaging versus lump sum investing. So let's say someone has a lump sum and they're looking at the market and they're thinking, it seems a bit overvalued. I'll wait till there's another crash. And they keep waiting and waiting, and the market keeps going up and up and up. There's only really been about 2 points in the last 5 years where it would have been good for them to invest, which is here in 2018 and then again obviously in March of 2020. But you'd have had to have been extremely lucky to get in at both of these low points. So it's very unlikely that anyone actually did. Whereas if you contrast that to someone who's been dollar cost averaging consistently month after month, the exact same amount, they've got in at all of these low prices, they've been part of this dip, and they'll have taken advantage of the dip in March as well. So statistically, it's been proven that the person who dollar cost average over this long period of time versus the person that has their lump sum on the sideline and waits for a dip will always come out the better. So if you've got a long-term investing viewpoint, dollar cost averaging is the best way to maximize your returns. So just to show you an example of dollar cost averaging taking effect, I'll show you my portfolio. So I've just got today's filter on. I haven't added any money whatsoever today. We started off the day at €1,800 invested, and we were sitting on about a 4.25% return. And you'll see as the day went on, we even dipped down to 3.5% return. And then as the market kind of came back to life, we got back up to about a 7.3% return. So you'll see here, I didn't invest any more money. This is purely compound interest and dollar cost averaging taking effect. So I didn't change my strategy whatsoever in the last couple of weeks. I invested the same amount that I always invest every single month. It's purely just the fact that I was able to take advantage of the low costs while they were here, the market dipping, the fact that I always had capital on the side ready to go. I may have pumped in a tiny little bit extra in the dip, but my strategy has been consistent time after time, month after month, and now I'm seeing the reward of that. So that's it for today's video. Hope you guys enjoyed it. Let me know, how did you take advantage of the dip? I know a lot of people were very excited about getting in on Tesla. Seems like they've rebounded a little bit, but they're still a good bit below their all-time highs. I'm looking at buying a little bit more of Palantir while it's still low, and then Neo as well. But yeah, let me know in the comments what you guys took advantage of and got nice and cheap in the last couple of days, and how your portfolio is looking. So with that being said, guys, thanks a million for watching, and if you're not subscribed, it'd mean the absolute world to me if you click the subscribe button. So I'll see you guys in the next one.